All right, it's another week. And actually, not just any week. This is the week right after Christmas, which is usually a pretty slow time for the markets, slow time for the news. But there is plenty of news for us to cover. And the Lazy Cash just made his appearance for what we call What the F Happened. And that's what we're going to cover. We're going to talk about what the F happened. We're going to rant, we're going to rave, and we might argue with you about the news. So stay with us. We'll be right back after this. All right, welcome back. Another week of What the F Happened. Joined here by none other than Mr. Lazy Cash in the house. He never misses a good live or webinar. And then also Mr. Nagy. What's going on?
Hey, it was wild. I was moving the screens around for a minute when that intro video was playing, and it opened up one of the tabs with the greatest secret in the world on YouTube. So it started auto playing. So it was playing the greatest secret in the world intro along with the What the F intro, and it sounded really cool together. So we might got to do a little mix since the greatest secret in the world has been a hot topic for us here this month so far.
I love it. Well, there's been a lot of hot topics for 2023, but you know what? As we move into 2024, it is sure to be a blockbuster, being the fact that we've got a very controversial election, coming up, all sorts of stuff going on in the political landscape, all sorts of stuff going on in the currency landscape. We're going to talk today a little bit about an article I just read all about the yuan, which is Chinese currency, or China's currency. I didn't want to say Chinese, but it is the Chinese currency that they use. We'll talk a little bit about the yuan. We'll talk about the euro, and we'll talk about how they're stacking up against the good old-fashioned U.S. buck or the dollar. Not only that, we're going to talk about some lawsuits. We got some lawsuits in the news. New York Times is suing Microsoft, ChatGPT maker OpenAI, and that's all over copyright infringement. So here we go. We're going to talk about the Magnificent Seven. We're going to talk about the wars going on over there in the Gaza Strip with Israel, and it's just insane. It's just insane. And then the Ukraine-Russia war going on. What else is in the news is, well, Treasury bonds, just like we've been talking about, are still doing their thing. The Fed came out, opened the front door for rate decreases in 2024, which we covered last week. I think that spells a little bit of a better picture about what 2024 is going to look like, because if they're dropping rates, that means things are not good. Okay, I want you to be aware of that. They raised rates to combat inflation. Inflation is coming down, but very slow, and they will stick to their plan of a target of 2%. And then, opening the door, which I think is just completely idiotic, the way that Jerome Powell mentioned that, and other people in the Fed said the same thing. But I think that says that the economy and the markets are going to be weaker than they are now. Contrary to everything you hear in the news, just remember the news is mostly fake, and they're constantly saying, oh, it's going to be a soft landing. And what does that do? That gets everybody all excited. They plow money into the markets. That is a trap. And we've covered that a lot. But one other thing, too, I saw, and let me come over here to Yahoo Finance. I thought this was really, really interesting. Let me find the article, and then we can kind of dive in and start talking about this. Oh, where the heck is it? I should have just had it right up on here. Oh, Warren Buffett. We all know the name. Warren Buffett, we can talk a little bit about how much cash is Berkshire Hathaway sitting on. Well, if you look, there is a 7% increase. Okay, they increased their cash by 7%. Now, you might not think that's a big number, but when you're talking about how much money Berkshire Hathaway has, Warren Buffett, to some of you, it's $157 billion. That's how much cash he's sitting on. Why is Warren Buffett sitting on cash if the markets are so good and the economy is so good? Why wouldn't he deploy that money? Buy more Apple, buy more Bank of America stock, buy more Coca-Cola. My gosh. I mean, why would he just sit on cash, and why would he grow his cash position if things are so good? Says the dude, says the news, says everybody saying, oh, soft landing, everything's good, the economy is going to be fine, people are still employed. Yeah, now. So I think these are some of the baseline things we can talk about today. Stephen, what are your thoughts?
Yeah, I mean, there's like you said, I mean, you hear two different stories coming from two different sides. I mean, we had one of our money school 3 days essentials virtual trainings that we do about a year or two ago. A couple of years ago, we had an economist on named Harry Dent Jr. And he actually was in the news this week talking about his predictions for 2024. So I can kind of read through that, Chris, because it kind of is the counter to what a lot of the talking heads on TV here I'm saying. So talk through that. But yeah, I mean, just a lot happening right now for sure.
There's definitely a lot happening, but I mean, let's start with the one, right? Let's start with currencies. Let's start with the US dollar, the euro, the won, the British pound. I mean, what's going on there? A lot of people say that the dollar is going to die, right? I don't think that's the case, because now, although, and this is an interesting stat, the SWIFT, okay, which is the Society for Worldwide Intrabank Financial Telecommunications, hence why they call it SWIFT, reported that 3.6% of global payments were denominated in the won. Now, that again has no basis with what you're hearing right now. But when I tell you this should give you a little bit of an inkling of what's going on. So that 3.6% of global payments being denominated in the won is double the amount of global payments denominated in the won in 2020. And it's about 65% more than 2022 averages. So what I'm trying to say is the won is becoming more prevalent in worldwide trade. Now, you could also then come back and you can say, well, the greenback, the US dollar, is still the king, because it is. I mean, but last time I reported on this and looked at this, the US dollar accounted for over 60% of US trade. Right now, the US dollar is roughly 47% of global payments. Now, I might have it wrong based on the news. Like maybe the global payments and global trade, I think, could be two different things. So don't think that we went from 60 down to 47. I think we're talking two different things. Let's just talk global payments. Okay. 47% were the US dollar. The euro was 22.95%. The British pound is 7.15. And then, as you know, 3.6% is the won. Okay, each gave up less than 1%, allowing the won to step ahead of the Japanese yen. This article goes on, and it's an economic article from an economist that I follow, and it just goes on to talk about the different things that are happening and why this could be going on. Not to alarm you, and Stephen's got it right there, kind of showing up on the screen, the different things from the SWIFT. You can see that there's been increases in denominations and in exchanged in the won. Actually, that's pretty steep. What do you got? Like, looking at that chart, Stephen, what do you think of that?
Yeah, I mean, it's like the Wall Street Journal says that China's won is quietly gaining ground. I mean, doing nice and slowly. I mean, China's in it for the long haul and everything that they do. I mean, and just, to them, 1,000 years is like 10 years to us. And so they're willing to play these long games. So you never know what's going on over there. It's something to definitely keep an eye on.
So I'll keep going with that. So it goes on to explain why, right? This article doesn't just say, oh, the won's gaining ground, like the Wall Street Journal. It actually gives some reasons why. And it talks a lot about the Russia-Ukraine war and the sanctions. Sanctions are a huge reason why the won is gaining ground, because we put sanctions against Russia. We don't buy Russian oil, which... That's funny because we probably are. It's just mixed. So Russian oil is then mixed with other oils from other countries and then sold as like Indian oil or I don't know, oil from other places. I don't know why I can't. Saudi oil or whatever, where we still buy from. It's just being blended. But one of the things that's interesting here that it said is Russia could recycle. Let's see, get this right. Russia could recycle by purchasing goods from China in exchange for using the won. So because there's all these sanctions, the European nations, the United States put sanctions against Russia, which obviously would hurt Russia. So Russia then starts trading in the yuan, selling oil to India and also to China, but they're all exchanging it in the yuan. So that's a big reason. So you got the sanctions, which are a reason. So those could end with the Russia-Ukraine war if the Russia-Ukraine war ever ends, which all wars end. It's just they go on for a long time, which is a sad fact of reality. And then it's talking about how Russian oil is being mixed with other oils, and then it's being sold, like, for example, with Iranian oil, and then it's being sold back as Iranian oil or being sold out there in the public so that it doesn't have to go through the sanctions. There's so much crap when you read into this stuff. It just makes you really think, like, what's real and what's not. And it brings me to another article that I saw on CNBC, where everything in here keeps saying S&P 500 8-week winning streak. It just keeps talking about the bull run. It just keeps talking about how everything's so good. The markets are going up and everything's fine. And as you keep reading here, it just keeps talking about it. Keeps talking about, everything. And then here's an article: 10-year Treasury yield dips as investor weigh 2024 outlook for interest rates. In other words, are we going into a recession or not? There was another article that talked a little bit about, in 2023, earlier in the year, we almost said for sure there's going to be a recession. I still think there's a for sure on the recession side. However, it's sitting there saying that is not so much likely anymore, because now they're thinking the Fed's going to pull off a soft landing. They're thinking that the Fed's going to be able to kind of smooth this thing out, and that even if we do have a recession, it'll be a mild one. Now, I don't know what all of you think, but just look at the facts. If 2024 has a mild recession, 2025 is not going to be pretty. So it's kind of just like kicking the can, right? You keep kicking the can further and further and further. And then you got to weigh in, is that good, or should we just let this thing go down, let it cleanse itself? Because there's so much garbage going on in the market, so much just manipulation. There's more Ponzi schemes, just coming to light now than I think any other period of time. And that's all normal because we've been in a bull run for over 12 years now. Longest bull run in history. But the problem with a long bull run like this is it starts making, a couple things. First, it starts making people feel like we're always going to be in a bull run, but it also allows, like when you're talking about something over a decade, it allows generational changes to happen. For example, millennials are aging into the working force, and now the primary working force would be younger working force would be millennials. As baby boomers retire out, you got millennials coming into the workforce, taking over those positions. But millennials, anybody 38 years old or younger, have never felt the true impact of a recession, because the last real recession we had was 2008, the Great Recession. So millennials don't know what a recession feels like. They don't know what it does. They don't know what it impacts. They don't know how it impacts assets, asset prices. They don't know how it impacts the markets. And they certainly don't know how it impacts people's decisions. And it does. And one of the biggest decisions I can tell you from having experienced 2 recessions in my time, one of them while being a financial advisor, which was probably the greatest learning lesson of my life when I almost went bankrupt. During a recessionary period, here's typically what happens. You have a lot of fear, okay? And then a lot of people will lose their jobs, because during recessions, it means the economy is weaker, which means there's less jobs, which means more and more people get laid off or let go during that period. And especially now, because right now we have some of the lowest unemployment numbers ever. And please, please, please don't try to tell me that that's because of the dude and the dude's policies, because it is not. Okay. It is because we were shut down for like 2 years and nobody worked. And then they started opening things back up. They took the mask mandate off and things started to boom. But why did they boom? Can anyone tell me why they boomed? Anyone? Anyone know why? It's because they printed $5.2 trillion. That's why. It's the only reason why. There was so much money in the system that allowed the markets to just go bonkers. And not only was there $5.2 trillion printed, we had some of the lowest interest rates we'd had in decades. Really, some of the lowest interest rates we have had since the Great Recession. And actually, they held the rates lower longer. So because it was a lot of excess money and a lot of very cheap money, things went crazy. Asset prices skyrocketed. Inflation was created, even though the Fed said it was transitory. And then the Fed said, oh, it's not transitory. And then the Fed said, oh, we're gonna solve this inflation problem. And then the Fed said, oh, we're going to raise interest rates. And the Fed said, oh, we're going to unwind the balance sheet. And on and on and on. And here we are today. So don't think that things are really good and rosy. This is like a hangover, right? All this is the hangover from the party. And it was a banger of a party. So you got a deep hangover, and that hangover is what the after effects of $5.2 trillion in low interest rates for too long of a period of time. So I just cannot buy into this news. I can't, and I won't, because I just think all it's doing is painting a false reality, a literal house of cards. And then you can support that easily by talking about why the S&P 500 is making, well, potentially before year end could set new highs. The Dow right now is up 28 points. The S&P 500 is up 3 points. The NASDAQ's up 19 points. So could we make new highs? Yeah. But then I don't think we can go much higher. On what grounds? Are they going to print more money? No. Are they going to lower interest rates? Definitely not until we hit close to the 2% target. So it's just a house of cards. The Magnificent Seven, the 7 stocks that are holding the S&P 500, the 500 largest stocks make up the S&P 500. And that whole index is being held up by 7 stocks called the Magnificent Seven. Look them up, folks. So I'm just trying to get you pointed in the right direction. And I said this last week. I know sometimes some of you're like, you say the same thing every week. It's because I'm trying to drill it in. You know, Stephen, myself, and my entire team and a whole bunch of other people we took a 30-day challenge. Stephen mentioned it earlier. And that 30-day challenge is we're all listening to the strangest secret in the world, which is a 31-minute recording that Earl Nightingale did. When was that, Stephen? The 50s?
Yes.
It was done in the 50s, okay? So we're listening to a recording that was recorded in the 50s, and we're listening to it 30 times. The same recording 30 times, and part of the challenge is every single day we have to send a text to a group text or a DM to the IBC Facebook group, and that has to be, what did you take out of that 30 days? Now, some of you are like, that's crazy. How can you learn anything by listening to the same thing over and over for 30 days? I assure you, every day, your life is different. And every day, you will take what he says and the laws he talks about, the universal laws, and you will apply them differently each day based on your circumstances. So based on that same thing of listening to Earl Nightingale's Strangest Secret in the World 30 times, okay, over 30 days, is the same reason why I continue to repeat the same thing every week. It's not because I'm forgetting that I said it the week before. No, I'm trying to get you to really let it sink in that what we're seeing, what the markets are doing, is a house of cards that will collapse. Okay. It is not real. It is completely based on manipulation and speculation. Look those 2 words up if you don't know what they are. S&P being held up by 7 stocks is right there, should tell you that there's a problem. Bitcoin has been rallying, which has also been helping the markets right here. Bitcoin's 2023 rally drove some of the stock market's biggest gains this year. You might be looking at it saying, what the heck? What does Bitcoin have to do with the stock market? It has everything to do with the stock market. They're so correlated when they should not be correlated. Correlated means they act and react the same. Like Bitcoin goes up, the stock market goes up. The stock market goes up, Bitcoin goes up. When you look at things, those two, a decentralized currency or decentralized, coin, Bitcoin, and the U.S. markets, the two really should not be correlated, but they are probably the most correlated of any asset classes out there. So when Bitcoin goes up, the stock market goes up, or vice versa, the stock market goes up, Bitcoin goes up. But the same true holds when it goes down. So you just got to look at these things. You got to pay attention to these things. And here's the final thing I'll say, and then we'll move on to one of the other topics. There's not a lot of news. As we get ready for the new year, we're going to set our goals. We're going to write down all of our goals, right? That's what you're going to do. You're going to write your goals down. TikTok, Instagram, YouTube, Facebook. You're going to write your goals down for 2024, right? Here's the thing I can't comprehend. This is where my logic supersedes my emotions. People are putting money in the markets. I argue with financial advisors every single week. And I argue with them because I can't understand why they would want to put their clients in risky assets. Why would they want to put all the money in S&P 500, NASDAQ, Microsoft, Apple, any of the stocks? Because all stocks rise with the tide and also fall with the tide. Why would they put their clients who do not have the risk tolerance and the appetite for risk, why would they put them in the markets at all-time highs when the economy is softening, when the Fed's talking about lowering rates into the following year, possibly, which signals to me that things are going to be weaker than they are today? Otherwise, why would they lower rates, right? It doesn't make any logical sense. With all these things, all these headwinds coming at us, with an election in 2024, which is sure to be like a blockbuster show, if you will. I mean, get the popcorn and the soda ready. It's going to be quite the spectacle to watch what nonsense goes on with the dude and all the other, yahoos that are running for presidency. With all these things in war, and now, shipping lanes are being attacked. Cargo ships are being attacked. It's almost like the prophecy is just happening right before us. Why would an advisor put your money in the markets? Why? When you can get paid to sit on the freaking sidelines, you can get paid over 5% sitting in money market accounts, buying treasury bills, buying T-bonds, okay? Treasury bonds, all which have guarantees by the full faith and credit of the U.S. government. Why would you not just sit on the sidelines is what I can't understand. Like, it just makes no logical sense. Please, somebody tell me. Why would you go in the markets when you can sit on the sidelines and make over 5%? Stephen, what do you got to say about that?
Faith in the Federal Reserve, I guess. I mean, if somebody believes they're going to keep pumping this market and keeping it up into the elections, maybe they're looking to play in that. But when you look at the markets at all-time highs and just tilting right there, it's like, how much risk are you given to get that little bit of extra reward there? It doesn't make sense to me.
So I got to hit some comments here, and Cash is conveniently right in the way, but I gotta come over here to TikTok. So I always like to start with TikTok because it's the funnest one and I get to argue with people. But right here, TB Michigan. You with us, TB Michigan? So everybody, TB Michigan on TikTok, TB Michigan, welcome and meet everybody. And no, you cannot join live. But here's the comment that TB Michigan said. He said, he or she, it looks like a he, the economy is good. We pull back. Basically, I think he's saying we will pull back and go higher. Nvidia will be higher than 5%. So let's see. TB Michigan also said fear, fear, fear. I think he's just commenting on some of the things I was saying. So I just want to kind of get his opinion. He said 5% is for poor people. Okay, so in other words, TB Michigan is saying that making 5% is for poor people. Interesting analogy. I've never really compared a 5% rate of return to only the poor people want 5%. So TB Michigan, you must be saying I'm poor. Stephen, I guess I got a lot of work to do, man. If my net worth is poor, that's interesting. You have faith in the government. Actually, I have zero fucking faith in the government. That wasn't TB Michigan. Sorry. And then he said, yes. When inflation is running at 3.5, keep going, TB Michigan. I'm tracking. What else? 5% stinks. So what he's saying is TB Michigan is saying when inflation is running at 3.5%, 5% stinks. Let me fact check TB Michigan. Folks, pay attention to what I'm going to say because I'm going to teach you something here that TB Michigan hasn't learned in economics class. Let's just do math. Stephen, can you help me do some math? Let's just assume that you're in a money market and you make 5%. Let's 5%. Okay. And inflation's running at 3.5%. What's the difference?
1.5.
5 minus 3.5. Let's just do the difference.
1.5.
1.5%. You make a spread of 1.5% guaranteed. Now, let's go back to when things were really good in the economy, okay? The Gilded Age, I don't know, whatever you want to call it. Just back when interest rates at a bank were 0%, inflation was trending probably around 2.5%, but you made nothing or less than 1% in money markets. What was your spread then? Just go with target inflation, 2%. Inflation's 2%, and you make nothing in your checking and savings account, which was a time not that far ago. What's your spread?
I think you're losing
Negative.
a couple percent there.
Right, you're losing. Do you all realize that right now, today, we have a unique opportunity to make a risk-free return? A risk-free return. It's one of the only times in a long time that we've been able to do this. But yet TB Michigan doesn't quite understand that, because he's saying 5% stinks when inflation is running 3.5. So TB Michigan must be saying that when we were at a target inflation of 2 and you got paid nothing, that was good. But the markets were rallying back then too. Marginal propensity to save. Let's see, what else we got here? Sorry, I'm going long, 1.5. Nvidia will double. So TB Michigan thinks Nvidia will double. Might as well put all your assets in, dude. If you're so convinced that Nvidia is going to double, put all your money in Nvidia. It's like going to the casino and putting it all on red when you don't know if it's going to hit black or in the middle. So, and then he said dividends in banks and Altria is better. All risk assets, TB Michigan. TB Michigan, I literally, I don't want to ruin the lie, but I want to see how old TB Michigan. How old are you, TB Michigan? Let me just ask. My guess would be under 40. How old are you?
I would say under 35.
How risky? Dude, how risky? What are you talking about? Low beta? Fuck your your technical indicators. Go to the fundamentals. He's 50 years old. Okay, which is interesting. So TB Michigan, you're 50 years old. You're actually older than I am. You've been through recessions. You know the impact of a recession. You know the impact of a falling economy. How do you figure that putting money in Nvidia doesn't have risk? Low beta stocks like Altria. Altria is an interesting one, and I'll give you that one, okay? Because Altria typically will do well in a recessionary period. It's not recession resistance, but it does fare well in recessionary periods. Dividend yield is better than 5%, but TB Michigan, you're missing the point. Risk-free return is 5%, and you're talking about putting money in risky assets, which is any stock. Any stock would be deemed a risky asset versus guaranteed asset classes. That's all we're talking about here. I'm not saying Altria is a bad stock or Nvidia is a bad stock. I wouldn't put money in them right now, but that's to each their own. But what I'm trying to, Altria is risk-free. Oh, that's interesting. Fuck, I didn't know that. Stephen, do you know Altria is risk-free? Did you know that Altria, a stock, has a guarantee? Shit, man, I learned something every single day. Altria is a guaranteed stock, I guess. Stephen, I need you to do me a favor, because TB Michigan is going to get my attention now, because this is just idiotic. Pull up Altria. Pull the stock chart up. And let's go back and let's look at Max for you, TB Michigan. I can't believe you just said that. Like, we were having fun up to this point. Now I'm just gonna destroy you, dude. Altria is risk-free. You are delusional. That's what you are. Okay. Is large cap growth too risky at 50 years old? That Speaking the Truth said that. That wasn't TB Michigan. Speaker of Truth, sorry, it got in apart. Is large cap growth too risky at 50 years old? That's relative. I don't know your risk return profiles. I don't know your suitability, but it could be. If you don't want to take risk, if you're afraid of losing money, if you large cap growth, if you're afraid of losing 20, 30, 40%, then yeah, it's too risky. I mean, look at a diversified portfolio. You know, if TB Michigan loves Altria, maybe dollar cost average into it to reduce risk. He said systematic risk versus non-systematic. So he's getting technical on us here. Hello, I am triggered because I like arguing on this show. Do you know that when I argue with people on this show, people love it, and people come to this show because I argue with you or argue with anybody? It's awesome. Breathe, TB Michigan said. I am breathing. I'm breathing just fine. Otherwise, I'd be turning blue. You see, that's the difference. But what I'm trying to explain is that Altria is not risk-free. So I know you can't see this, TB Michigan, but I know you pulled the chart up a lot. So Altria's high what are we looking at? We're looking at how many years is that? My eyes aren't that good, Stephen. What are we looking at?
2017, it was at about $77 a share.
So 77 a share in 2017. Okay. Where's it at now?
40.
So let's just say somebody bought Altria in 2017 and they're holding it now. Did they lose money or make money? Even if you factor in the dividend, there's no way they made money. Even if you factor in the dividend, they lost money. I wish I could talk to you. Yeah, TB Michigan, get on the list. It basically is. Okay, so everybody else, can everybody else help me here real quick? If Altria goes from 77 down into the 40s, okay, and then I didn't see what was the dividend on Altria, and I know it's going to be different every year, but if you factor in the dividend, have you made or lost money? Anyone? Made or lost? Forget about technical analysis. Okay, listen, I used to trade solely on technical analysis when I traded derivatives and options, and I did all sorts of interesting things. So I'm putting all that aside because listen, TB Michigan, I understand what you're saying. Okay, do a bond versus Altria. So if I did a Treasury bond, like a 30-year T bond against Altria, we are not doing an accurate comparison, TB Michigan. You're comparing a risk-free asset, okay, a Treasury bond, to a risk asset. It's not an accurate representation. It's just not an accurate comparison. So I don't know what you're trying to prove. Do a 10-year bond, okay, but you're still comparing a risk-free asset, a Treasury bond, which is guaranteed by the full faith and credit of the U.S. government. Now, listen, if you don't believe the U.S. government's going to make their payments and you don't believe the Fed is going to continue to print more money so that the U.S. government can make the payments, well, then I guess I could see your point. But, then we got a whole different discussion. Do a 30-year-old. How long of a period of time do we want to do this comparison, TB Michigan? Because you know what? You're trying to do a comparison during the longest bull run in history. Of course, Altria is still going to beat it. But what I'm talking about, you want people to buy Altria, a risky asset, over a bond. Why? Why would somebody want to do that? Anyway, all right, I got to move on because Cash just threw his head against the screen, so he doesn't feel like having this discussion. But there are stocks that act risk-free. I'll give you that Altria is a good stock, okay? It's a good defensive stock. But I will not agree with you that Altria, for somebody that is looking for low risk or no risk, is a better choice for somebody. And you cannot say Altria is risk-free. You literally, if you were a financial advisor with a Series 7, you would be in deep shit for telling a client that. Matter of fact, you'd be sued and you'd go through arbitration and your record would get dinged. That's exactly what would happen because Altria will lose money. It will go up. It will go down. Okay. All stocks will lose money when the market gives way because all stocks will go down. That's just how it works, man. It's just how it works. So what do we got, Stephen? We got any good?
Yeah, I will say though, he's might be right about Nvidia because he's following what Nancy Pelosi does, and Nancy Pelosi on a Friday, right before Christmas weekend, bought several $1 million of Nvidia calls, long calls for the end of next year, I believe. So
wow, she went out to the end of next year.
Maybe he knows. So, maybe he's just following.
TB Michigan, are you following Nancy Pelosi's trades? Isn't there a mutual fund that was put together that literally tracks Nancy Pelosi's trades?
There is, and it's up something like 500% or something since it started.
And that's not corruption, and that's not manipulation, and that's not insider trading. No. Because those in Congress and those in the House and those in the Senate, they can do anything, and it's not insider trading. But God forbid Martha Stewart does some insider trading. Whoa, man, oh man. Calls are a way better trade, Michael said. Let's see. Chris is your Tommy. I can't read that, Stephen. Of finance, just a little mid. Apples and oranges, Michael said. Yeah. Mr. Stinky, I'm not losing it. I'm just having some fun. It's year end, right? We got to have some fun. And TB Michigan just happened to be the one who, has triggered me and just kind of, we're just having some fun. A little Altria, a little Apple, a lot of Nvidia. Okay, so you are completely tech heavy. I mean, if that's your thing, go for it. And maybe you'll do good. He's getting a car wash, though. Getting a car wash. Can't hear us. So we'll let him get his car wash. We'll move on to another topic. It's kind of fun to burn a little bit of time just kind of chatting with someone like TB Michigan. I sometimes just get a little irrational in what I say, but that's more just because people like when people argue. I don't know why, but that's just how it goes.
All I know, Chris, is I'm sitting here feeling like a king. I got this new office chair from Santa for Christmas, and this thing it's comfortable, man. I'm telling you.
That thing looks nice. Let me see it.
Let's check this thing out. Let's check this.
Wow, that looks awfully fancy, man. Look at that.
Baby. Look at
wow.
That, so I'm feeling good. I got the bad back, so I gotta support. You know what I mean?
Maybe that's my problem. Maybe I'm angry just because my chair's not as comfortable. Now, my chair, I'll just give you a preview of my chair. So there's my chair.
Yeah,
it looks
I've
nice.
sat in it. It's not bad at all.
It is pretty plush, man. It's not too shabby. Not too shabby. So maybe we should buy stock in these chair manufacturers.
How about
Trevor's lost?
How about Bernie Sanders? Bernie Sanders is an interesting character, isn't he?
Yeah, I just read something the other day that Bernie Sanders went to Epstein Island. He was one of the people on the long list of Epstein Island. But anyway, what about Bernie Sanders? The only reason I say that is I just can't picture Bernie Sanders going to Epstein Island, but I guess he did anyway.
He just half the stuff he says is batshit crazy, but every now and then he comes out with a banger. I thought this one was pretty good from yesterday, a couple of days ago. He said corporate greed is Mark Zuckerberg becoming $3.4 billion richer today while building a $100 million mansion in Hawaii with 30 bathrooms in an underground bunker. Meanwhile, a record-breaking 653,000 Americans are homeless and 60% are living paycheck to paycheck.
Don't even get me started on that rabbit hole. We're just talking about Mark Zuckerberg. Explain to me why we're sending as much money as we are over to Ukraine when there's homelessness here. There's people on our own soil that need help. I sometimes can't understand that. Actually, I can, but I'm not even going to go down that rabbit hole.
Yeah, it just sometimes you're just like, man, if you really think about that, though.
Let's see.
To your point, what you were talking about earlier with kind of everything that's going on, something we've been talking about all year are all of the commercial loans, all the commercial real estate loans that are coming due over the next couple of years. And this article just came out. I'll share this just because it's kind of relevant to that story. So this is saying U.S. banks could get slammed with another $160 billion in losses as commercial real estate faces its biggest crash since 2008. We've been talking about this all year, and it's kind of one of those things that's like, it's a major deal, but it just gets swept under the rug because they don't want to have any negative news out there. But this is something to definitely keep an eye on. And as the banks are already closing branches and banks are closing for the first time in a decade this year, this is really going to start impacting banks as these start to default.
Yeah,
so this is something to really keep an eye on, Chris.
It's a really big thing to keep an eye on. Not only that, Yahoo Finance top line, main headline news is that JP Morgan, it was a tough year for almost every bank not named JP Morgan. So it's going on. I mean, we all know the name JP Morgan. I talk about the Morgans and the Stanleys all the time. I mean, with the infinite banking concept, and they were some of the original users of privatized banking, hence using whole life insurance policies as a banking system. You can go back and fact check that one because it's all over the place. More than a decade after regulators vowed to tame the risks of too big to fail banks, White House officials were on a call. Why? One attendee asked, was JP Morgan Chase and Company allowed to buy First Republic Bank that morning in the government-led auction? Well, that's interesting. The answer came flatly from the Secretary Treasury, Janet Yellen. They had the highest bid. After a year marred by the biggest bank failures since 2008's financial crisis, the nation's largest lender is on familiar footing, scooping up a weakened rival, reeling in its clients, and minting record profits along the way. So, I got kicked off TikTok. Interesting. TikTok keeps kicking me off. So you know what we're going to do? We're going to play a little game right now. We're going to have some fun. We're going to get crazy. We're going to go live again. Oh my God. Okay, please explain something. I just got suspended again from TikTok. TikTok suspended me. I didn't mention the dude's name. I didn't talk about anything bad. And TikTok literally suspended me. Isn't it kind of funny how a Chinese social media platform keeps suspending me? Anyway,
we did open up talking about the yuan this morning.
We did, but I mean, I was just reading off of an economic report. Like, didn't say anything bad about the yuan. I actually said positive things about the yuan, but yet, yep, suspended. Look at this, folks. Like, can't make this shit up. Suspended. Oh, well, sorry about that, TB Michigan. We can't riff anymore, but, so I think it's worthy to talk about banks, banks where so many people keep so much money. I would urge you all to get your money. If you got more than $250,000 at any one bank, you need to reconsider that. Don't believe that the same thing's going to happen as it did for Silicon Valley Bank and all the others where they got bailed out. That's not going to continue to happen. Okay. It's not. Banks are absolutely in deep shit. Number one, they don't have liquidity. So if there is another run on any bank, the bank's only liquidity is Treasury bonds and maybe Treasury bills. But the bonds right now, that's changing. And actually, Stephen, if I can share my screen real quick, let's see. I want to just put this up while I talk about this because I want you to all understand. Where is it? Got to find it here. Sorry, folks. I got a lot of things open. Here we go. There it is. All right. So Instagram, sorry you can't see this. It's a how do I make this bigger, Stephen? You and your apples.
Hit a Command plus.
Command plus. Oh, there we go. All right. So let's see. We got to make this a little bigger. Find my mouse. There it is. All right. So all I'm doing is I'm just pulling up an ETF of Treasury bonds, which are actually up. Holy cow, Stephen. I just made a lot of freaking money.
Yeah, man.
You see that? Listen, this is the first time I'm seeing this, folks. And I'm going to come back to banks. But do you see how much TLT's up? How many of you on here have been listening to me and have been really, really looking at Treasury bonds, 20-plus year Treasury bonds, or possibly took a position in Treasury bonds? Anyone? You just put it in the chat right now if you actually took positions in Treasury bonds. Because Treasury bonds today, 20-plus year treasuries, are up $17. In one day, I made 20.75%. And any of you that have Treasury bonds, you just made the same. Now, that's a bit strange. I can't explain to you why these Treasury bonds spiked outside of the fact that the yields are going down pretty rapidly because of the Fed's action. As the markets are going up, the yields have been going down. Now, this is interesting. I got to tell you, this is interesting because this does not send a good picture about where the markets are going. Because typically, if price of Treasury bonds are skyrocketing like this, which 99.63, I was telling all of you to buy them when they were down around 80 and 85. And yes, we lost more money after that, but you just made 20% if you bought Treasury bonds right freaking in front of you. So why do I bring this chart up? Well, not to get excited about what we just made this morning, but really I want to talk about what happened to banks, why banks are suffering. You see this right around here, okay, around 2020. So banks, for their tier one capital, they either buy BOLI, bank-owned life insurance, whole life insurance, or Treasury bonds because they need their tier one capital guaranteed. So a lot of banks' reserves, which is only about a little smidgen over 10%, okay, because the rest is fractional reserve banking, they got to keep 10% in guaranteed assets. So when there's a run on the bank, we all know that there's no money in the vault, right? We know that there's nothing there. We know that the Brinks trucks, when they bring in all the bags of money, it's all just a facade. It's like a TV show, okay? It's a sitcom. Okay, it's just to make you feel good. When you're in line waiting for your money, they bring bags of money in. Okay, but here's the thing. Banks buy Treasury bonds. Usually not 30-year like insurance companies, but they buy 2-year and 10-year. So when the Fed started raising interest rates, I just want you to look here, okay? Look at the date. March 20th, 2020. And Instagram, just follow along with what I'm saying. I'm sorry I can't show you this because StreamYard has not yet included you, but we've got 102 people listening to this, so this is great. $159. Let's just say banks are buying Treasury bonds. What happens right here, okay, which down here is, I can't even get to it. What happens when you go from buying treasury bonds at 169 down to having to sell them at 116, okay, or having to sell them at 100 or having to sell them at $88? What happens when you got to do that? Okay, I'm just showing you the trend line of where treasury bond. The reason treasury bonds have gone down in price, all bonds, all long-term bonds would do the same, have gone down in price, is simply because interest rates went up. So as the Fed raised interest rates to combat inflation, price of treasury bonds went down. When there was a run on the bank, the banks had to sell the treasuries to make money so that they then could make their depositors whole. Okay, so you see where the problem was. That's what took down Silicon Valley, probably what took down Republic. But you see, this is just a small little piece of the iceberg. You know the story of like the part of the iceberg you see on top of the water doesn't tell anything. It's what's below the water that's really the important thing. The problem with banks is below the water. Same thing they did in 2006, 2007 with mortgage-backed securities and taking on additional risk. They've been doing now, but it's not been in the residential mortgage space. It's been in the commercial mortgage space. CMOs, okay, CTOs, all sorts of things. You can study those, but banks have so much risk when it comes to commercial real estate that it's not even funny, and there's nothing they can do about it. So as commercial real estate starts to weaken, as the price of real estate continues to go down, okay, which I know we just had an uptick in single family home prices, but commercial real estate has been going down. As that commercial real estate price goes down, it puts more and more pressure on banks. Because remember, if a bank gave somebody a 30-year mortgage or a 20-year mortgage at 80%, if commercial real estate falls below 20%, which is very likely, and in some places it's very likely to happen, banks are underwater on all of those mortgages. So then if the businesses start to default, which is already happening, if they start trying to foreclose on these properties, banks can't handle that risk. Hence these articles that Stephen just pulled up. I know I'm talking slow today, okay, because I'm trying to just let this stuff sink in. It's year end. Some of you, got the week off, which is great. I love that, and I'm just trying to let this stuff sink in, but I can't change the fact that for months, for over a year, I've been preaching treasury bonds, risk-free assets. Why? Because I knew what was going to happen, not just because I was a financial advisor, and Series 7 book is probably 60 to 70% bonds and inverse relate. It talks all about bonds in the Series 7. Okay. So I understood that very well, but I also understood the economic environment we are in when the Fed started raising rates. I knew eventually the Fed was going to decrease rates, and I knew that we were going to go into a recession because of the inverted yield curve and all the other signs, which I've been talking about week in and week out. And I knew eventually when rates went down, the price of treasuries would go up. I did not expect this.
That's not, just so you know, that chart's reading weird, Chris. They're not up that today. It's showing like more of an all-time deal, but I don't know why it's showing that the way, whatever you have pulled up there on Google.
So listen, it was like a Christmas present that they decided to give me. I mean, I just pulled it up in Google, but all right. So if this chart's wrong, I apologize.
Look like 1 day or 5 day or something, it'll change.
Yeah.
But to your point though, rates are definitely dropping right now, and that, they are inverse. So the prices will go up.
That's a little bit more realistic. Okay. We're up 0.78%, but wasn't that cool? Didn't that feel good? Because listen, like what you just saw where I thought it was up 20% for today. Now, obviously that was a mistake, in the technology, but here's the cool thing. Eventually we will be up there. Okay. Eventually the treasury bonds will go up as the price goes. So as interest rates go down, the price will go up. So that will become a reality. It's just not today. Anyway, I'm going to stop sharing. Thanks for the correction on that. Thanks for ruining my day. I literally thought we had a big pop in the price, but that was fun to dream, right? Fun to dream.
On that, I mean, this is a pretty cool little article with some charts, Chris. You like charts? Let me share this real fast. So it's just talking about how the financial conditions are the loosest they've been since May of 2022. How the Fed is kind of really loosening things back up right now. So despite resilience in U.S. data, the 30-year yields have plunged back below 4%. So you can see those things just dropping like a rock right now. Mm-hmm. And if we scroll down through here, the last few weeks have seen U.S. macro data reverse its recent trend of disappointment. So you can see the dropping, and now we're kind of reversing. The long end of the curve is outperforming. So I'd have to really kind of zoom into that, but just give you an idea. But do not fight the Fed seems to be the narrative, and expectations for a March rate cut are rising once again. So you see odds of a March rate cut are really increasing. So they think that they're going to continue to drop rates with this loose financial conditions. The market is pricing in over 160 basis point of cuts for next year. Financial conditions are now at the same level of looseness as May of 2022. See that right there? That is 300 basis points of Fed rate hikes ago. Is this really what the Fed wanted? So it's kind of a little bit about, what they're doing and what that looks like through charts, which is kind of cool.
That's interesting. Thanks for pulling those charts up. And, folks, some of you may or may not understand that. Some of you might not even know what basis points means. 1 basis point is like 160 basis points is equivalent to 1.6%. You just got to change the decimal point. So it's a term commonly used in Wall Street, and many of you probably know how to use it, but just understand, when you're talking about basis points, you basically just move the decimal point, and then you got a percentage. It's just a lot easier for people to understand that. What else we got in the news? I'm looking through here. Let's see. Color purple wins the holiday box office with second highest Christmas debate. Useless news. Cars. Oh, this is interesting. This one just popped up. Cars are losing their values at a slower rate. So cars are now holding their value, but remember, they're always going down in value. Hence why you should use the infinite banking concept to buy cars, because then you get all the money back for every car you ever buy, drive, and own. Doesn't matter how fast or how slow the value of your car decreases when you get all the money back. Anyway, shameless plug. Had to do it, Stephen. It is year end. We had to get that in there.
I love it.
All right. So
yeah, I mean, we could, Amazon Prime is going to start charging if you don't want ads. So if you watch any shows or anything on Amazon Prime on January 29th, they're going to start showing ads on everything, unless you want to pay $2.99 a month to avoid the ads. So you're going to see a lot more of that, I think, with, as streaming is becoming bigger and bigger. I don't know, this article from Harry Dent Jr. might be the way to end this thing, Chris.
Oh, yeah. Or you could pull up that thing that I sent you this morning on here. Actually, I can't. My phone. Crap.
Let me see. Which one was it?
I sent it to you this morning. Let's see. I don't know where it is. I think I DM'd it to you, I believe. Did you get that?
I don't know. There's so many different platforms these days.
No, it was a Facebook article that I had sent you.
No,
that's pretty interesting. I can't remember it, and I've got my phone being used. Anyway. All right, let's go to the Harry Dent Jr. one.
Yeah, I mean, he's just talking about predicting that the 2024 will bring the biggest crash of our lifetime, and some of his reasoning in that. I mean, I can read through it real quick. It's a pretty quick article.
Yeah, I follow Harry Dent, and he's been wrong a lot, but right a lot.
I mean, so it just gives another perspective on kind of how to look at everything that's going on. So since 2009, it's been 100% artificial, unprecedented money printing and deficits, $27 trillion over 15 years to be exact. This is off the charts, 100% artificial, which means we're in a dangerous state. I think 2024 is going to be the biggest single crash year we'll see in our lifetimes. I'm the guy that's praying for a crash while everybody else is not. We need to get back to normal, and we need to send a message to central banks. This should be a lesson I don't think we'll ever revisit. I don't think we'll ever see a bubble for any of our lifetimes again. Denton, who spent the majority of his career analyzing proprietary research, credited his against the grain prediction to overvalued markets and excessive stimulus spending. While recent rallies have overwhelmingly provided investors with mild recession expectations, Denton remained firm that an everything bubble will burst next year. Historically, market bubbles are characterized by a rapid rise in stock prices before being met by a sharp fall. The Economist noted that this bubble actually started in late 2021 after the height of the COVID pandemic, with the first signs showing in 2022 when NASDAQ was down 38%. The new year will bring the B wave of the crash. The roaring 20s bubble was not an everything bubble. A real estate barely bubble in 2008. It was stocks and urban real estate that bubbled. Dent said, "This is the one time I'm telling you, do not listen to your financial advisor. Things are not going to come back to normal in a few years. We may never see these levels again, and this crash is not going to be a correction. It's going to be more like 1929 to 1932 level. And anybody who sat through that would have shot their stockbroker. That's an 86% crash in the S&P and 92% crash in NASDAQ. In crypto, it's going to be 96%. So that's a big deal. And real estate, by the way, is only projected by me to go back to its 2012 lows. But that's a 50% crash for the average house, which went down 34% in the last crash, more than the Great Depression, more than any time in history. That is what's going to hurt people the most. And then he criticized investors, just talking about how ridiculous these levels are in the stock market. He said, if I'm right, it's going to be the biggest crash of our lifetime, most of it happening in 2024. You're going to see it start and be more obvious by May. So if you just get out for 6 to 12 months and stuff stays at the highest valuation history, maybe you miss a little more gains if I'm wrong. If I'm right, you're going to save massive losses and be able to reinvest a year and a half from now at unbelievably low prices and magnify your gains beyond compare. We're still up there. We're still near highs, and that shouldn't have happened. So you've gotten a gift. You've gotten this rebound where we get you a second chance to get out near where you could have been. Boy, that's lucky, lucky, lucky. That's what we talk a lot about, Chris, is where is it going to go versus where it is today, you know?
Yeah.
So that's
definitely. No, it's interesting. I mean, a lot of what he says is exactly what we talk about every single day. And I think one of the biggest takeaways you can get from, everything that Stephen just read about Harry Dent's, what was that on, Stephen?
It was from Fox Business News.
Fox Business News is, that you've all gotten like a second chance. Very few times in life do we get a second chance, but you did. You get to do a do-over, if you will, a second chance to take your profits off the table and to get out. And then I like how he said, worst case scenario, you sit on the sidelines for 6 months. What did you lose? Not much. You don't lose much at all. That's the thing that with TV Michigan, like I was arguing with them, like I'm just trying to simply point out, like sitting on the sidelines, allowing FOMO to fly away and fear of missing out and all the emotional based decisions you make with investing, allowing them to just be put aside to right now, just take a breather. As we, kind of go into the last week of 2023, I think that's a good thing to kind of end this on is, this is a great time to just relax, to reflect, to write down your goals, to really just see where you want to be in 2024 and what are your goals. And I think one of the goals that all of you should put down on that sheet of paper or wherever you track your 2024 goals is to not lose money. And like Harry Dent just said, you get a second chance. Right now, we're up 79 points. We're up across the board. NASDAQ's down, but you get a second chance. Don't let that go. Like, don't let a second chance in life ever pass you by. And don't be afraid to sit on the sidelines. Don't be afraid to just stop and ponder and just think. There's no rush right now. You're not going to get rich in a couple months. Nvidia is not going to probably double, in the next couple months. Just sit back and watch the show. Sometimes that's more fun. We spend so much time buried in a phone that we miss so much. But, I think a lot of times, and listen, I'm guilty. Steven's probably laughing inside with me saying this. Like, I'm guilty of being the one that never relaxes, never slows down, never stops to smell the roses. But you know what? This week, I'm taking most of the week off to just do exactly that, to sit back, to reflect, to listen to Strangest Secret in the World, sometimes twice a day, to just really just ponder things that you don't get to ponder when you're going. And I think, when you really think about the end of 2023 going into 2024 is going to be an interesting, wild ride. No ifs, ands, or buts about that on so many different levels, political, geopolitical, like all the different things. It's going to be a wild ride. And wouldn't it be comforting to just sit on the sidelines and watch it all? Just not have any risk in it, not have a game or not have a dog in the fight, just to sit back and just watch it. And that's what you have the ability to do. You truly have the ability to do that. Why are you not taking that chance? I'll leave you on that. Stephen, what do you have to say to close this up? I know we've got another 2 shows today.
Yeah, 1:00 Eastern, wealth webinar. Join us. Go to chrisnaugle.com. Just scroll right down the page. It's a free event we do every Wednesday at 1 p.m. Eastern. And we'll dive into a little banking concepts today, some real estate investing strategies for the new year, and kind of what to do now to be planned and ready for that, and get yourself set up. I mean, what is your plan to make yourself better in 2024? What audio books are you listening to? What podcasts are you consuming? What live events are you going to attend? What virtual events are you going to attend? I mean, one thing that I've done in the last couple of weeks, Chris, is I bought on Amazon a wall calendar for the whole year. So I have the whole year right there on my wall in front of me, and I have the dry erase markers. So I write in all the masterminds we're going to, all the events that I'll be at, all the trainings that we're conducting. So I can see my each year, and every month I have 2-3 things that I'm doing that are just, whether I'm providing the education, which teaches me as well, or I'm going and attending somebody else's event. I have stuff every single month that I'm doing to make myself better, so we can bring that and share that with our community. So, hopefully you're doing a lot of the same things. And now's a great time to do that. Like you said, reflecting back on this year and going into the new year over the weekend. So thanks for being here today, everybody. Look forward to 1:00 today, and hope everyone has a great new year. It has a great weekend. Be safe out there. Some good football games. Hopefully have some good time with friends and family. And we'll see you guys next year, because 2024, we are absolutely stoked about, regardless of what happens with the elections, the economy, the markets. If you're in control of your money, in control of your life, at the end of the day, none of that stuff matters. And that's what this is all about. So thanks for being here with us in 2023. And we really do look forward to next year with every one of you.
Yeah, one thing we always say internally is the worse it is out there, the better off it is in here. The infinite banking concept, everything is better when things get rough out there. So I'll leave with one thing, and that is go Bills. We'll see you at 1:00 this afternoon, 1:00 Eastern, for the wealth webinar. Go to chrisnaugle.com to register. There's no cost, and you get my 3 books for free. We'll see you at 1:00.